We started the day off with a very poignant speech, interview, whatever you want to call it, from legendary investor Paul Tudor Jones, multi-billionaire, been around for a very long time, with a beautiful Southern accent. And he said a lot of things we've been talking about on this channel. A lot about the Fed, a lot about inflation. And then we saw the market not really react completely to what he was advising and what he was talking about, but still saying and still relying on one thing that he did say, which is that if the Fed doesn't do anything, just keeps doing what it's doing, stays the course, doesn't change, doesn't do anything new, that the NASDAQ will rip. So to start the day, we saw some tech stocks rally really hard. The NASDAQ do very well, while the other indices, major indices, were down. And I think that's a pretty accurate move if the Fed doesn't do anything. If there's no raise in interest rates, we can expect interest rates to continue to be in this weird zone where somehow they continue to fall. But if you remember the videos of last week, we talked about how this market, the interest rate market, was highly manipulated. And in due time, it can't be manipulated any longer. And there will be the negative effects or the more natural effects of what has been happening. And that was the crux of what he was saying, that if this coming week, when the Fed talks and gives its statements, if they decide to remain the course, he will go all in on the inflation trade. And this is what we have been doing. And a lot of our stocks were not doing so well today. And it was interesting. For example, the oil stocks, they were all down, yet the price of oil was up at was up at 71, which is a very high level, highest in over 2 years, back to 2018. And the higher we go, the farther back we're going to go in that comparison. And the move is likely to continue. The move is likely to continue. Why? Because India is still offline. Demand is generally suppressed. The UK is going back into some sort of lockdown. Europe hasn't fully opened. The United States hasn't fully opened. So we can expect the price of energy to continue to rise and likely hit the Goldman Sachs price target of $80 per barrel and beyond that. It is very much possible that it goes beyond that level. And if that's the case, these energy stocks are grossly underpriced. So we want to have exposure to them. And on days like today, when they're down, we should be adding to that exposure and getting long those positions, because we are here to make a lot of money over the long term and buy well-priced stocks. And it seems last week they pulled back. Today they're pulling back. The energy stocks are still a place to go. Our three hot sectors that we acknowledged at the end of 2020 and into 2021 were energy, gold and mining, precious metal stuff, and real estate. And those still remain the ideal sectors to have exposure to going into the future, considering that there's going to be some inflation. Because if the longer the Fed does this, the more inflation there's going to be, and the more these stocks are going to see their run. So in the short term, maybe people are focusing on tech stocks because interest rates are coming down, but we view that as a short-term move, and not anything to get super caught up in. Definitely have some tech exposure. Don't go all in on the inflation trade. Paul Tudor Jones said that. You probably will make money with that, but we like to have a little bit of both growth and inflation, cyclical, dividend-paying stocks. But the growth and the tech we like to have, I don't want Amazon. I don't want Apple. I don't want Facebook. Those companies have had their run. They seem to be, maximum potential right now. We've had, every company that's gotten to this level that these companies are at hasn't maintained their status at that level for the next decade. So we're going to see what happens in this decade and the following decade. Apple's been great. Amazon's been great. These are great companies, but we will see what happens. Regardless, the stock price is super high, is already factoring in about 30 years of earnings and massive growth. So they're expensive. What is not expensive are earlier stage, smaller, lower revenue companies that imply more risk. But if there's reward to be seen, and if the thesis is correct, should 5 to 10x. and that is greater than the rate of inflation. Here's the thing I disagree with about the whole inflation long-term cash flows thing. I actually think that if there's inflation, maybe it makes bonds more competitive because they're paying a higher interest rate, but I expect tech stocks revenues to also adjust for inflation, just like we've seen in the housing market. So I'm not scared about owning tech stocks if I expect a 5 to 10x return or multiple or importance of their technology over the next decade. So I'm going to continue holding those, but I'm also going to continue adding to energy positions on days like today and selling at a loss any short-term positioning I have, or rather downside positioning I have to tech, just because I do agree with Paul Tudor Jones. There's a good chance that the Fed remains doing what it's doing this week. I expect that to be the case. And interest rates to remain low for the foreseeable future, which allows tech to rally because it had gotten caught up in fear about rising interest rates. And that's not happening as of right now, so things are cooling off there in that fear department. But if our inflation stocks come down, that still remains the long-term story. Stick to the script, add to those positions. Be disciplined, have a plan. The plan is continue to own inflation stocks. Forget the short-term chatter, forget the interest rate move. We know where interest rates are going in the long term. We know where inflation is going in the long term. And therefore, we know where the inflation stocks are going in the long term. Tech stocks, sure, they might be caught up in inflation rate or interest rate and inflation rate swings. That's, I guess, the way it's going to be. But if we are buying tech, we expect a 5 to 10x. We don't need to worry about that. We just need to hold for the future and love our technology and believe in the future. So that's how we're positioned. And until next time, peace out.